$500K in phantom income could be hiding in your ILIT life insurance policy right now, and the IRS won't warn you until it's too late. Your estate planner told you this policy grows tax-free inside the trust, but surrender or let it lapse, and you could owe $50,000 to $200,000 plus in ordinary rate taxes on money you never received. By the end of this video, you'll know exactly which IRS form reveals whether your policy is a tax landmine, and the 3 scenarios where surrender charges eat 20–40% of your death benefit before taxes even hit. Let's go. Here's the wrong belief most people hold. An ILIT life insurance policy grows tax-free inside the trust, so surrendering it is just comparing death benefit to premiums paid. Simple math, but that's not how the IRS sees it. When you surrender or let an ILIT policy lapse, IRC Section 72 triggers phantom taxable income equal to the difference between total cash value and total premiums you've paid, and that income is ordinary rate taxable, not capital gains. The IRS doesn't mail you a check, you owe the tax anyway. Let's run the real numbers. Imagine a $1 million death benefit ILIT policy funded over 20 years with $800,000 total premiums paid. The current cash value sits at $500,000. Your policy is aging, premiums are rising. You're deciding whether to keep feeding it or exit. If you surrender, here's what happens. Cash value $500,000 minus total premiums $800,000. Wait, that's negative, so no gain. But if the cash value is actually $1 million instead, which is common in older, well-funded policies, you now have $300,000 in phantom income. At 37% federal plus state combined high-income earner, that's $111,000 in taxes owed on a surrender. Then layer in the surrender charges. Most policies assess 20–40% of cash value as a surrender fee. On $1 million, that's $220,000, $440,000 gone to the insurance company before any tax hits. Here's where it gets worse. The IRS publication that governs this, IRS Publication 539, states that life insurance contracts with modified endowment status are taxed last in first out. You pay tax on gains first, not premiums. If your ILIT policy crossed the MEC threshold, more premiums paid than allowed under the 7-pay test in the first 7 years. Every dollar you withdraw or that triggers taxable gain is taxed as ordinary income. No stepped-up basis at death, no deferral. The delta between what you expected and what you actually get is stark. A $1 million intended estate transfer becomes a $600,000, $700,000 net transfer after phantom income, surrender charges, and resulting AMT, alternative minimum tax, liability. So how do you know if yours is silently hemorrhaging? Look for Form 8949 in your last tax return. That's where life insurance gains are reported. If you've never filed one, ask your CPA to pull your policy illustration from the insurance company and calculate total cash value minus total premiums paid. If that number is positive and over $50,000, you have embedded taxable gain. Request the policy's modified endowment contract status from your insurer. If it's flagged as MEC, every surrender dollar is taxed first. The 3 scenarios break down like this. Scenario 1, keep the policy and pay premiums. Tax outcome, 0 immediately, but rising premiums may exceed income value long-term. Scenario 2, surrender now. Tax outcome, phantom income plus surrender charges plus potential AMT spike. Scenario 3, let it lapse. Tax outcome, similar to surrender, phantom income is triggered the moment the policy terminates, even though you received nothing. The IRS still sends you a 1099-R and expects payment. Research from the NAIC, National Association of Insurance Commissioners, shows that surrender charge schedules typically decline over 20 years, dropping 1–2% annually. If your ILIT policy is 10+ years old, you're past the steepest decline. But if it's newer, charges can still exceed 30–40% of cash value, combined with phantom income. Your net cost to exit is often 50–70% of the policy's cash value. The silence from the IRS is the real trap. They don't proactively warn you, they wait. When you surrender, the insurance company files Form 1099-R showing the gain. Your tax bill arrives in April. By then, the cash is gone. The solution? Run these numbers now before you decide. Consult your estate planning attorney and a tax professional who understands IRC Section 72 and MEC rules. If the policy's tax cost exceeds its death benefit value, you may be able to restructure or use a 1035 exchange, tax-free policy swap under Section 1035 to move into a lower surrender charge contract. If the policy has genuine value, keep paying. If not, the cost of exiting now might be lower than the cost of years of rising premiums plus eventual phantom income. The core takeaway: your ILIT policy isn't as tax-free as you thought. Phantom income and surrender charges are real. Run the math before your next premium is due. If you want the full implementation checklist and every IRS form you need to request from your insurer, the deep version is in our companion book, HSA Millionaire Hack, link in the description. If this shifted how you see your ILIT, hit subscribe. Next video, how step-up basis actually works and the $500K plus mistake most heirs make within 60 days of death. Ring the bell so you don't miss it. What's your biggest takeaway? Surrender charges, phantom income, or MEC status? Drop it in the comments. The tax code rewards those who study it.